Every nation on earth carries debt. The United States shoulders $38 trillion. Japan owes $9 trillion, and the world as a whole an astonishing $315 trillion, 3 times larger than the global economy that supports it. Yet behind these vast numbers lies a paradox that should give any historian pause. If every country owes money, to whom is the world indebted? The answer is not what most imagine, because once you trace the creditors, once you follow the long paper trail stretching across centuries, you discover something unsettling. The world does not owe its wealth to an external master. Instead, it owes money to itself. But this outcome did not emerge by accident. Across 3 centuries, four financiers constructed a system that ensured debt would never disappear, a framework in which governments borrow endlessly, interest rises eternally, and the architects of the system profit in both prosperity and crisis. This is not conspiracy. This is documented history. The meetings were real, the contracts preserved, and the mechanisms still shape our economies today. To understand how global debt became permanent, we must examine 4 pivotal moments and the 4 men who engineered them.
AXCI 1694, William Paterson and the birth of permanent national debt before 1694. Kings borrowed the old-fashioned way. They appealed to merchants or nobles, promised repayment with interest, and if they failed to repay, they defaulted. Creditors took the loss, monarchs found new lenders, and the system reset. Debt was a temporary burden, not a structural feature of government. Then came William Paterson, a Scottish merchant with grand ideas and a string of failed ventures. In 1691, as England struggled through war with France, King William III faced an empty treasury and a skeptical lending class. England had defaulted before. Traditional lenders refused to extend more credit. Patterson proposed a radical solution. A group of wealthy merchants would lend the crown £1.2 million, enormous sum on one extraordinary condition: the loan would never be repaid. The government would pay interest 8% annually forever to manage this perpetual debt. Patterson proposed creating a new institution, the Bank of England. The mechanics were revolutionary. Merchants deposited gold into the bank. The bank lent it to the government. The government paid interest from tax revenues. The merchants received that interest indefinitely. And most crucially, the principal, the original sum, remained untouched. The debt was permanent. Parliament approved the plan in 1694. The Bank of England was born. The Crown secured its war funding, and for the first time in world history, national debt became a permanent fixture, not a temporary burden.
But Patterson's real innovation lay in the bank's newly granted power. It could issue banknotes backed by government debt. Debt itself became money. The more the government owed, the more money the bank could create. This was the blueprint for modern finance, and every major European nation soon adopted it. Act 2, the early 1800s. Nathan Rothschild and the internationalization of debt. By the early 19th century, European governments were borrowing constantly, but the system remained disorganized. Loans were local, interest rates inconsistent, and only the wealthy could participate. Then Nathan Rothschild changed everything. The Rothschild brothers built a financial network spanning London, Paris, Frankfurt, Vienna, and Naples, the fastest, most connected banking system in Europe. And Nathan, operating from London, used this network to transform government borrowing. His innovation was simple and profound. He created a secondary market for sovereign debt. Instead of directly lending to governments, Rothschild bought government bonds at a discount, resold them to investors, and pocketed the spread. Governments received funds instantly, investors obtained tradable assets, and Rothschild controlled the flow. During the Napoleonic Wars, his courier network delivered news faster than any government. In 1815, he learned of Napoleon's defeat at Waterloo before London had official word. By selling British bonds, first then buying them back when prices collapsed, he made a fortune. But more importantly, he demonstrated a new truth. Information itself was power. By 1820, the Rothschilds dominated European sovereign debt, and because bonds were now traded across borders, default became dangerous. A single government's failure could ripple through multiple countries, banks, and investors. Debt had become so interconnected that default was no longer simply a financial disincident, was a threat to the international system itself. And thus the trap tightened. Governments had to keep paying, had to keep borrowing, had to feed a growing web of obligations that could never be safely unwound. Act 3, 1910. J.P. Morgan and the American Central Bank. By 1900, the United States was rising as an industrial giant, but its financial system remained fragile. Banks operated independently, tied to gold reserves. Money supply was limited and crises frequent. In 1907, panic struck. Markets collapsed. Banks failed. And J.P. Morgan, the most powerful banker in America, personally organized a rescue. He forced New York's leading financiers to pledge their own funds to stabilize the system. The crisis passed, but Morgan knew this model couldn't continue. He wouldn't live forever. America needed a centralized system to stabilize credit. One that looked remarkably like the Bank of England. But Americans distrusted central banks. The Weiss before they had dismantled national banking systems. Popular sentiment was fiercely anti-bank. So Morgan and his allies moved in secrecy. In 1910, a small group of bankers and politicians men tied to Morgan's circle met on Jekyll Island, Georgia, far from public scrutiny. Over 9 days they drafted the foundations of what would become the Federal Reserve System, a central bank designed by bankers, presented to the public as a safeguard for the common good. The Federal Reserve Act passed in 1913. A new era began. The United States adopted the same perpetual debt architecture that Britain had pioneered more than 2 centuries earlier. The pattern revealed from Patterson to Rothschild to Morgan. The design remained consistent. Debt becomes permanent. Interest becomes unavoidable. Money itself becomes tied to government borrowing, and the system grows more interconnected with each generation. Today, when nations owe trillions, it is not a failure of policy. It is the system functioning as intended, a system built over 3 centuries by 4 architects, 4 pivotal figures, who reshaped how the world understands money. And once you see how they built it, you understand why modern debt cannot be repaid, why governments must borrow endlessly, and why the world today owes money to itself. If the American public had known that bankers were quietly designing the nation's monetary system, the reaction would have been immediate and violent. So the architects of the new order turned to political misdirection. Their plan was subtle, brilliant, and effective. The institution would not be called a central bank. It would be called the Federal Reserve System, and it would not appear to be one powerful entity. It would be presented as 12 regional banks scattered across the country. It would not look like it served Wall Street. It would be overseen, at least in appearance, by a board of governors appointed by the president. To the public, it looked decentralized, democratic, accountable. But beneath this design was a structure that ensured banker control. The regional Federal Reserve banks were privately owned by the member banks of each district. Those member banks elected the boards of the regional feds. And the regional feds, in turn, selected the leadership of the Federal Reserve Board in Washington. Government appointees sat at the table, but they did not run it. And the most critical power of all, the authority to create money and purchase government bonds, was placed in the hands of the Federal Reserve Bank of New York. The bank, run by the largest Wall Street institutions, the heirs of J.P. Morgan's empire. The Federal Reserve Act passed Congress in December 1913, largely because few lawmakers understood its true implications. And from the moment it became law, the debt system expanded. For the first time, the United States government didn't simply borrow from banks. It borrowed from an institution that could create money on demand. The process was simple and profound. The government issued a bond. The Federal Reserve bought that bond with newly created money, the government spent the money, and the bond moved on to the Fed's balance sheet backed only by the promise that taxpayers would service it indefinitely. This was the mechanism that made infinite debt possible. The Federal Reserve guaranteed there would always be a buyer for U.S. bonds, always demand. The government would never need to stop borrowing, and the interest payments funded by taxpayers flowed upward to the banks that owned the Federal Reserve. SYSTEM J.P. Morgan died in 1913, the same year the Fed was born. His influence did not. His legacy became the structure that makes today's $38 trillion American debt possible. Without the Fed, the market could never sustain such borrowing. With it, there is effectively no limit. The 1980s. Paul Volcker and the globalization of the debt trap by the 1970s. The system engineered by Patterson, Rothschild, and Morgan had become global. Wealthy nations borrowed in perpetuity. Their debts rolled over effortlessly. Interest payments flowed like a river into the financial system, but developing nations were different. They borrowed heavily for infrastructure and many teetered on the edge of default. Then entered Paul Volcker, chairman of the Federal Reserve from 1979 to 1987. The United States faced double-digit inflation. Confidence in the dollar evaporated. Foreign governments questioned the stability of the world's reserve currency. Volcker believed inflation had to be crushed, regardless of the consequences. In 1979, he made his move. He raised interest rates from 11% to nearly 20%, the highest in American history. It worked. Inflation fell, but the consequences were catastrophic elsewhere. Throughout the 1970s, developing nations had borrowed billions in U.S. dollars at low interest rates. Now, as those loans came due, interest payments had tripled. Mexico owed $80 billion. Brazil, $60 billion. Argentina, $40 billion. The interest alone exceeded what those nations earned from exports. In August 1982, Mexico announced it could no longer pay. Such a default should have collapsed the global financial system. American Bank, Citibank, Bank of America, Chazod lent heavily. If Mexico failed, they would face enormous losses. Some might not survive at all. Volcker could have let the system reset. He could have allowed the banks to absorb their losses. He chose another path. He orchestrated a rescue not for Mexico, but for the banks. Through the International Monetary Fund, the United States and its allies provided enormous loans to Mexico, Brazil, Argentina, and others, not to reduce their debt, but to ensure they could continue paying interest to American banks. These were called structural adjustment loans, and they came with harsh conditions: deep cuts to government spending, privatization of public assets, market liberalization, currency devaluation in exchange for the funds needed to continue interest payments. Nations surrendered pieces of their economic sovereignty. This was the Volcker innovation. When debt becomes unpayable, do not erase it. Restructure it. Keep the payments flowing. Bind nations to perpetual dependency. The debt trap became not just permanent, but geopolitical. This strategy has repeated for 4 decades. Greece in 2010, Argentina in 2001, Sri Lanka in 2022. Each time, IMF loans maintain payments, austerity is imposed, assets are sold, and the debt persists. Volcker died in 2019, but the world still runs on the machinery he set in motion. The system completed 3 centuries. 4 architects, their lives never overlapped. Their motives differed, but piece by piece, they built the modern world. Patterson made national debt permanent. Rothschild made debt global and interconnected. Morgan created the mechanism for infinite government borrowing. Volcker ensured no nation could escape even through default. Together, they forged a system where governments borrow eternally, taxpayers fund the interest forever, and the institutions that hold the bonds accumulate wealth without producing anything. Today's $315 trillion in global debt is not a crisis. It is the operating system. None of it will be repaid. All of it will pay interest. And the entire system is so interlinked that a default in one country can threaten the stability of the world. This is the debt trap. A structure centuries in the making, a mechanism so deeply embedded that escape would mean collapse. For architects. 3 centuries, one system, and everyone on Earth is now caught inside it. If this changed how you see government debt, if you finally understand that $38 trillion isn't an accident or a mistake, but a system working exactly as designed, then you're starting to see how power actually works. Subscribe if you want to understand how the machine was built, who's operating it, and why they never want you to look behind the curtain. Because they're not going to teach you this in school. They're going to teach you debt is a problem to solve. But the architects knew better. Debt isn't a problem, it's the foundation. And interest is the rent we pay to live in their world. But here's the part they never want you to hear. The moment people understand how the system really works, the entire structure becomes fragile. And right now, more people than ever are waking up.